Hello, trade pros. Sound check 1 2. Hope you're all doing well. Today I want to do a quick little live stream with you guys. 3 p.m. every Sunday we put up a video on a regular basis, and today I figured I'd go live and share a tip with you all. So we know that this past week the stock market's dropped a significant amount, and I want to explain to you the reason why stocks and stock markets in particular drop much faster than they tend to go up, and more importantly, how you could use this for your benefit and your advantage. So welcome aboard. I'm going to do a live stream today instead of posting the usual video. Just a reminder, tonight at 8 p.m. Eastern, we have our recurring market analysis live webinar for all subscribers. We pretty much go through and analyze the opportunities for the week ahead, what trades will make sense. We look at technical analysis and a bunch of other information as well, economic, forex calendar, what options trades you could have, levels. We go through a ton of information every Sunday at 8 p.m. Eastern, and that's for all of our members. So ahead of that, today we're going to talk more about this, but I'm going to answer the question, what makes stock markets drop faster than they go up? And there's a saying in the business that the stock market, and any asset for that matter, takes the stairs up and the elevator down. So they always drop much faster. So I'm going to give you a hypothetical example that I hope sticks with you for the rest of your trading career. All right, since about 2009, since the Federal Reserve really started to cut interest rates, and on top of it even included a stimulus package, borrowing has been very cheap. All right, and you as a consumer might be taking advantage of this already, be it your mortgage, your car loan, whatever it is. You're paying a very low interest rate to borrow money. Hey, Jan, how you doing? Giannis. How you doing, Giannis? Welcome to the live. So you're paying little money to borrow money. And what's been happening here, financial advisors, and coming from a background where I did sales on the investment side of the business as well, financial advisors are convincing consumers to borrow money and put it into the stock market. All right, so this is a way of taking leverage. You're taking a levered position, borrowing money you do not have, and putting it in the stock market, and it's advertised as a great way to invest your money and grow your gains and a long-term strategy. Now, the problem with this is it's all good and fine because the market's gone up a lot. All right, markets have gained a lot of traction. And when it really starts to fall apart is the first down day or down cycle, so to speak. So what happens? For the money that you're borrowing, you're being charged an interest rate. So you owe a series of payments to borrow that money. Well, what ends up happening is if you have a drawdown in the equity market like we did the past week, what ends up happening is you need to deposit more money. Let's say you had $100,000 that you borrowed and stock markets are down 5%. All right, so you've lost $5,000. So now you got to put in another $5,000 in your account just to make up for that loan balance. So what ends up happening is a lot of brokers will issue margin calls saying all clients in our brokerage need to deposit more money to hit the margin liquidity requirements. So you either deposit more money from outside, which at this point of the cycle, a lot of consumers are strapped. All the cash has been put to work. We've been borrowing for years on end, so we don't have any more money to put inside. So what does the broker say? All right, if you can't meet the margin requirements, I'm going to liquidate your portfolio. So they start selling positions that you own. Now, this selling goes in the open market. You'll see the drop. All right, it's vertical because there's a lot of selling at the same time. It's an initial margin call. But guess what? Now you're stuck with a loss. All right, now you got to eat that loss. So the next day, the same thing happens. All right, you don't have any more money to deposit. The stocks drop more. You get more margin calls. Now you're further underwater on the loan that you've been given. And this repetitive cycle of margin calls adds or tacks on to the sell side, and there's a virtual free fall because there's nobody buying. All right, because who would buy a drop like that? So there's two things really driving the downside and why it happens so quickly. Number one is the absence of buyers, and number two, it's a sudden accumulation of everybody piling on to the sell side. All right, and that's why when you see a market drop, it's very dangerous to say, oh, well, it's down 4%, perfect buying opportunity. All right, it's very dangerous to think the following sentence. As a trader, if you ever sat down and said to yourself, wow, this thing can't go any lower, all right, that's the exact opposite way of the way you should be thinking. And in fact, what I'm here to tell you guys is in a liquidation cycle like we just seen, there's usually more downside to come before a reversal. So in tonight's market analysis live, I'll give you the prospect for this week's market. I do think we're due for a rebound. but there was a wave of liquidation that happened last week. Institutional money was selling. All right, retail clients were getting stopped out. Speculative traders were shorting, and there was nobody out there. There was an absence of buying to support that market. Without a support, the price just collapsed. All right, so it's this cycle of stop runs. In addition to that, it's also margin liquidation, and in addition to that, it's the professional money hedging their downside. All that piles onto the short side. All right. So once these short sellers are basically, not short sellers, sorry, once these margin calls are done, all right, like you mentioned, somebody just mentioned a comment on there. It didn't stay up on the screen long enough for me to read it fully. But what's going to happen is there is going to be a rebound. Yes. If you look at the last crash in February, the way it ended was it V-bottomed and ripped back up to new highs. Now, are we going to see that this time around? The key question for this week coming up is this. Did we just see a healthy correction or a healthy nosedive that we needed to shake loose some of the longs at the very top? Because this bullish cycle was really overstretched. It was overexerted. There was everybody that wanted to buy the market was already long. So who's going to be the next person to buy it to drive it higher? And the answer was nobody. So there was a liquidation. The big question here is this liquidation healthy, normal? Was this just a shakeout of some late longs? Is the institutional money now going to come in and start buying these dips? Or are we in for the first bear market since 2009, since the housing bubble collapsed? There's a lot of ways to go for a bear market. We need to see 20% sell off in the market. We got about 5% last week. So I can't answer that question. Nobody can. Here's what you want to look for. The next thing you want to look for is, how does this rally look? On the way up from here as we're rallying, are you seeing volume accommodate, or are you seeing volume lockstep with the upside? And if stocks are going up and volume's increasing, then this could be a dip buying opportunity. Stocks are going up and there's absolutely no volume or very low volume. This is an opportunity where institutional money is waiting for a rebound to hit another block of sell orders and take this thing lower. That's what you're looking for this week. So glue your eyes to the volume and you have a lot of opportunity. You mind asking that question again? That was a good one. Let me see if I can click this button. Margin calls, more bullish next year, more Trump, tax, FOMO, 40K Dow Jones, and crash to 7,000. Sankt, you know, I'll be honest with you. I think that my personal projection was that we're going to see a deeper sell-off in Q1 of 2019, Q2 of 2019. But this year's midterm elections and midterm election years are pretty bad. And October in general, I'm going to share a report with our Market Analysis Live participants at 8 p.m. tonight. I'm going to show you guys how many of the last 20 crashes actually happened in October. So we got kind of Spooktober upon us. It is October now. Midterm election year cycle, which is typically a little bit weaker in a bullish market. And we got a lot of unknowns that are starting to pile up. So I'm on the fence. If I had to guess, I'd say 50% probability for new highs in the next couple months, 50% probability for a sell-off. But the way that the selling happened this past week, it felt different. All right, it reminded me a lot of 2009. I traded through 2009 and 2008. I traded the housing bubble collapse. I traded the tech market implosion, and it started to feel a lot like it was reminiscent of those days where there were no bids. We were just whacking any rally, any good old rally, and adding to the downside and making a ton of money. But again, I'll put that with a word of caution out there, that as we make money, somebody loses it. All right, on a down market, traders make money, but investors are getting hosed. So be humble and know that there's people out there genuinely getting hurt. So for the good of humanity, I'd like to see a rebound, but it's starting to feel and look different. It's just on the charts. It gave me an uncomfortable reminder of what the bear market was like in 09. All right. I hope that's not what happens, but that's what it's looking like as of this past week. The first 2 to 3 days of this week are very pivotal for the market. I'll tell you guys what to watch a Market Analysis Live. All right. Hey, brother. Thank you, man. You're a very good contributor. You comment a lot for us and support us. Sankt, I appreciate you too, brother. We're here for you and for our entire community. So thank you for commenting and really keeping up to date with us. I really appreciate that. And you and the value that you add in the comments. Giannis, good to see you. We'll see you tonight in our webinar. You guys, that's all I had for today. If you like this live stream, please give it a thumbs up. And put in the comment section, do you want to see more lives like this, a little bit more spontaneous versus the regularly planned content we have? I just thought it'd be fun. I'm actually in the parking lot right now, waiting to go to the gym. My gym's over there. I don't know if you guys could see it up there somewhere. And I figured to just go live before that. And I don't feel like I need to go to the gym anymore. I just sweat 3 pounds off the sauna in my car here. All right, guys. Take care. Have yourself a great day. I'll see you guys at 8 p.m. Eastern for Mark and Alice Live. And we got a lot of great content coming your way this week. Tomorrow at 9 a.m. we're back to our live morning updates. And we're going to keep you guys up to speed with what you can expect for the remainder of the trading week. Thanks for tuning in. Have a great day. Stay out of trouble for the rest of the Sunday. And I'll see you tomorrow. Giannis, you can't promise me you'll stay out of trouble. So you keep getting in trouble and enjoy it. Take care, guys. Thanks for tuning in, and goodbye. Off to go for a quick workout. Ciao.